In today's video, we examine the most recent challenges encountered by Dalian Wanda Group founder and billionaire Wang Jianlin. The once vibrant conglomerate of entertainment and real estate owned by Wang is currently struggling to pay off a sizable amount of debt. The billionaire founder of China's Dalian Wanda Group, Wang Jianlin, is in a precarious position as he tries to deal with a number of issues that put his real estate empire in jeopardy. Now let's get into the specifics. Wang Jianlin, well known for his achievements in the real estate and entertainment industries, has previously experienced cash flow problems. This time, however, regulatory barriers and a decreasing number of financing options are making his situation worse. Wang's ambitious plan to list Dalian Wanda Commercial Management, the group's property management division, in order to raise money, is looking increasingly unlikely. After 3 previous attempts failed due to unstable market conditions and increased scrutiny of the real estate sector, the unit recently resubmitted its prospectus for a potential Hong Kong listing for the 4th time. Dalian Wanda Commercial Management, DWCM, the parent company of Dalian Wanda, may be required to repay pre-IPO investors up to 30 billion yuan, roughly $4.2 billion, if the listing does not take place by the end of this year. This information was revealed in a letter made public by China's securities regulators. In addition, regulators have terminated the company's application to issue bonds worth about $830 million after Dalian Wanda Commercial decided not to proceed, according to an online notice. There is no doubt that Wang Jianlin is facing significant obstacles. Companies and their underwriters frequently withdraw such applications because of weakened debt servicing capabilities, according to Shen Meng, managing director of Beijing-based boutique investment bank Shanson & Company. Wang, who had a net worth of $33 billion in 2016, was once regarded as Asia's richest person. This circumstance represents a sharp turn in his fortune. His empire, which he built over the years through investments in real estate, finance, and movie theaters, is now facing a rapidly deteriorating environment as his wealth has fallen to $7.8 billion. Beijing now seeks to divert funding away from real estate in order to lessen the economy's dependence on this sector, despite earlier rescue packages aimed at preventing a full-blown crisis in the property sector. Because of China's sluggish recovery following the global financial crisis, authorities have refrained from implementing more extensive stimulus measures, such as increasing spending on infrastructure and real estate. Consequently, even as economists lower the growth projections for 2023 as a result of China's sluggish recovery following the lifting of the majority of COVID-related restrictions earlier this year, authorities have refrained from implementing broader stimulus measures, such as increasing spending on infrastructure and real estate. The fact that bank loans, bond issuance, and initial public offerings, IPOs, which were once potential sources of funding, are now primarily reserved for state-owned enterprises, SOEs, and strategic industry players, only serves to exacerbate Wang's difficulties. The University of Hong Kong's Chair Professor of Finance, Chen Jiwu, emphasizes that real estate developers and businesses in less strategically important industries struggle to find funding sources. According to Moody's Investors Service, DWCM can use its cash reserves and partially redeem short-term investments to repay its debt of about $13 billion that is due within the next 12 months, including the IPO expenses classified as liabilities. But as stated in a research note released by the rating agency on May 10, the company's liquidity will significantly deteriorate in the absence of new funding. Despite the intimidating challenges, Wang Jianlin is confident in her ability to overcome them. He recently succeeded in restoring investor confidence by repaying a $275 million private debt facility and obtaining a $232 million asset injection from the state-controlled bad debt manager Haorong into a local joint venture. Concerns were raised by these developments even after rating agencies further downgraded DWCM into junk territory. Even after rating agencies further downgraded DWCM into junk status, these developments took place, raising questions about the potential cash outlay for a failed IPO. However, Wang Jianlin is not the only person affected by the uncertainty surrounding the IPO process. The conglomerate as a whole is also affected. Regarding internal controls, related party transactions, and the veracity of Dalian Wanda's operating data, regulators have voiced their concerns and asked for more information from the company. The timing of the regulators' final feedback is still unknown, according to analysts at S&P Global Ratings, which adds to the uncertainty surrounding the IPO's approval. Concerns have also been raised about the sizable cash dividends of nearly $2 billion paid between 2019 and the first half of 2022, which outstripped Wanda's cash inflow during the same time period. According to experts, such dividends have been seen as a way to appease investors amid the repeatedly postponed IPO process. Pre-IPO investors, including major players like Tencent, Ant Group, CITIC Capital, and PARG, have expressed worries as the IPO hangs in the balance. The value of the property management unit, which was valued at $28 billion when the initial investment was made, has come under scrutiny due to the general downturn in the real estate industry and the underwhelming stock market in Hong Kong. Potential investors and regulators are both concerned about the repercussions if the IPO goes forward and shareholders decide to sell their shares, potentially worsening the situation. Host Wang Jianlin's long-term plans, which date back to 2016, have been derailed by the prospect of the IPO. Wang had initially taken the business private in Hong Kong because he thought it was undervalued, but when Chinese authorities cracked down on debt-fueled overseas acquisitions, he ran into trouble. In order to pay off Dalian Wanda's debt, Wang was compelled to downsize and sell a variety of assets. This led to a significant restructuring of the conglomerate. Host Dalian Wanda is also at risk due to the uncertain IPO process because 3 sets of offshore loans totaling $1.3 billion are reliant on the listing. Although banks have not yet requested early repayment, the consequences could be severe. Dalian Wanda has considered selling 20 malls in order to raise more money, but negotiations with local governments are necessary due to retention requirements. While selling a few malls has been somewhat successful, it is now more difficult to find buyers due to the financial difficulties of previous buyers. As things develop, Wanda might look into other options, like selling assets abroad or mortgaging malls that haven't been pledged before. The revenue may not, however, be sufficient to close the funding gap. It is yet to be seen whether discussions with regulators or pre-IPO investors will result in a workable solution to these difficult problems. We will continue to monitor the developments and keep you updated on any new information. Don't forget to like this video and subscribe to our channel.